In recent years, we've seen very cautious central banks prepared to cut interest rates, to add liquidity in order to guard against downside risks. Same thing is happening again today in the wake of the Brexit vote. Of course, in the case of the UK, this makes complete sense. The economy's crashed after the vote, confidence indicators have collapsed, and so the Bank of England is going to be cutting interest rates, adding liquidity to support the economy. In the case of Europe and Japan, it's a bit less obvious. They need to be stimulating, but they just want to put in some insurance, and so we're seeing action in both of those regions. In the case of the US, they're doing much better. The June jobs report showed the economy is still in good shape. The Fed is suggesting a December rate hike is quite realistic. They might even go as early as September, but I guess they'll wait till the end of the year. So overall, the outlook for the developed economies is not that changed. For emerging markets, we're actually seeing some signs of improvement.
1 month after Brexit, financial markets are behaving as if UK's exit vote had never happened. Stock markets, including the UK, have not only recovered from the post-Brexit losses, but have surged ahead. The US market moved further into uncharted territory as it touched new highs. The reason for the rally is the expectations of central banks overcompensating Brexit's effect with excessive easing. So far, central banks have been on the wait-and-see mode to assess Brexit's damage. Although the UK looks likely to go into a mild recession, there has been little economic and financial contagion. The early readings of Europe's economic data have shown resilience. Therefore, markets may be a bit too hopeful in expecting central banks to ease aggressively. The gains in stock markets are not supported by earnings. For stock markets to continue rising, earnings need to improve dramatically, and that's not happening. In fact, actual earnings are in negative territory, and analysts have yet to revise their forward earnings downwards, as we expect they will soon. With the plunge in low, long-dated bond yields, the low for longer outlook looks more entrenched, an outcome that has unleashed a powerful surge for yield, whether it's in the bond market or in the equity markets. Buoyant stock markets in the face of weak fundamentals and political turmoil need to be validated by actual economic performance. Otherwise, the rise in stock market cannot be sustained. As markets set new high, we urge investors not to chase this rally. Instead, investors should stay cautious and take some profit. Going into a more uncertain environment, we maintain our defensive posture for asset allocation. On equities, we continue to stay underweight in Europe in favor of the US. On bonds, we maintain our overweight stance on emerging market high-yield bonds as a key source of yield carry. More importantly, we advocate a hunt for yield strategy, whether it's from highly rated bonds or high-income equities.